Research at City, Markets Edition.
Welcome to Research at City Markets Edition, where we break down global macro in 10 minutes or less. I'm your host, Dirk Willer, City's Global Head of Macro, and with me today is Adam Pickett, our London Macro Head. Welcome to the show, Adam.
Thanks, Dirk. It's a pleasure to be here as always.
We are recording this podcast at 9 a.m. on Monday, November 3rd, 2025. It's either the best of times for investors focused on equity markets and productivity, or the worst of times for college grads trying to find a job. We have lived through a jobless recovery in the 90s. Now we are living through a jobless boom. What's going on? Let me start setting the scene a bit. So the Atlanta Fed GDP now Q3 estimate is running at extremely strong numbers in the high threes. Productivity is booming and sales per head for the S&P companies is strongly rising. Equity markets are up 16% year to date in the US and 35% since the April lows. On the other hand, the last published NFP from August was only 22K, and the 3-month moving average was as low at around 29K. We have a negative ADP print for September. Since then, we got weekly ADP prints, which are also quite low. The next NFP print should be out shortly in mid-November, and consensus for September is actually not so bad, but the October number is meant to be weak again. Anecdotally, grads are having a hard time landing an entry-level job. This is really quite rare. Last time we built a big equity bubble in 1999, which also had strong productivity numbers. NFPs were on average printing 250K numbers. The Fed was hiking. So clearly something is different this time around. Adam, talk us through the various hypotheses of what explains this disconnect.
Thanks, Dirk. We get leveled with 4: labor hoarding, tariff impacts, AI, and rate sensitivity. We tried to dig into all 4 recently. So on labor hoarding, the theory is firms hired a lot during the COVID rebound. They were uncertain about the future state of the economy, so they held on to them. And now we're seeing the give back of some of that hoarding. Now, if that were true, we would expect to see an inverse relationship between some of the positive hiring trends in 21 and 22 versus some of the more negative hiring trends this year versus the long-term trend. And we don't. We see a barely flat relationship on the scatter plot, so we don't give that answer too much credence. On tariffs, our economists have done some good work breaking up the jobs report into tariff-adjacent goods, tariff-adjacent services, and we did see a decent hit in June and July, but actually since August, there hasn't really been sort of a marked expansion in some of those tariff dynamics. And if anything, with some of the deals that have recently been signed, we would expect some of those headwinds to become tailwinds next year. On rates, we look at the interest rate sensitivity, or the beta, to the 2-year of the GICS equity level sectors relative to the S&P. And then we map that to the JOLTS hiring numbers, and we look at the 25 trend versus pre-COVID. And we do find a decent relationship there, whereby the sectors with the higher rate sensitivity have also experienced slightly weaker hiring trends this year versus the longer term average. So we do think that rate sensitivity is a decent angle to map this on. And as the Fed cuts, we would expect to see some tailwinds going forwards into next year. AI is a trickier topic. On a macro level, we use firm AI sensitivity and map that to recent hiring trends versus average. We actually don't find the inverse relationship that technological unemployment or productivity would suggest, i.e. the firms with a higher AI sensitivity do not have weaker hiring trends, they have strong hiring trends. So on a macro level, it's not quite there yet. On a more micro level, we do see evidence. So when you look at recent work from Harvard and Stanford's researchers, when they dig into subsectors, more micro subsectors that do have stronger AI sensitivity, places like computer coding, places like customer services, there's a really marked dispersion in headcount normalized over time between early career workers and late career workers, whereby mid and above basically continued to see headcount expansion, and the more junior sectors are seeing quite a marked downturn. So we think we could be at the beginning of this trend. It's not fundamentally what's driving the market just yet, but ultimately raises the risk that we have this sort of AI flywheel whereby the Fed cut into a boom. Dirk, more broadly, given everything that's going on, how do you think the markets are going to react to it?
Yeah, no, thanks, Adam. It's a two-part question, right? I mean, first, how will the market take it if employment improves? And that is interesting because the Fed is, of course, cutting only because of the employment mandate. And it's not clear just how much employment you need to keep the unemployment rate steady. So there was a Dallas Fed paper that argued with slightly negative net immigration, you only need 30,000 jobs a month. And with small positive net immigration, you need 60,000 jobs. So you don't need these 150K type of NFPs in the current labor market, given the supply side. And from that point of view, yes, if NFP recovers, then the Fed will have to become less dovish. And of course, a big part of the narrative for the equity market rally is that the Fed is cutting into a bubble, is cutting into at least a very strong bull market. And that has never happened before. But that is really part of the bullish narrative. So if we have to give up on a dovish Fed, that would clearly be a hiccup in the equity market. We don't think it would be that huge, and we think it will be temporary. The reason is twofold. First, as the job market recovers, the recession risk would, of course, go to zero. And we have a model that tries to suss out whether good news, good economic news is good news for the equity market or not. Currently, the model is saying good news is good news, which is actually the normal behavior during easing cycles. So the market likes good data. That can change, of course. But I mean, the other big argument is that we will get a new Fed chair. And from May onwards next year, will potentially be a Fed led by someone much more focused on supply side economics, and therefore probably somewhat more dovish and less focused on inflation, at least in the short term. And from that point of view, we think that the sell-off will be somewhat contained if the Fed turns more hawkish under Powell. The second question, though, is what happens if the AI job cuts come, and eventually they will. And then you hinted at it already, Adam. We see this flywheel kicking in where job cuts may happen due to AI. As a result, the Fed cuts. The market goes up more, you get more capex, CEOs feel better about it, you get more job cuts as a result of that capex into AI, and so it continues. So that would be really quite bullish equities, of course. And so we are really very positive into year end. We had originally upgraded US equities overweight back in April, but last week we increased our overweight actually.
Doug, that's all well and good, but equities are at the highs. It seems like there's already a bunch of optimism placed in. Do you really think pushing and adding length at these levels makes sense?
Yes, very good question, Adam. We have two studies. First of all, you cannot find any proof that buying a market at the highs is necessarily a negative for the outcome. And that's, of course, in the context of a long bull market that the S&P has had. So on average, it has not hurt you. But maybe much more importantly, we did a lot of work on the seasonals, and especially what we call conditional seasonals, meaning the returns for November and December dependent on what the returns were from January to October. And it's really quite interesting. But if you get the strong Jan to October performance that we had this year, you have a 94% hit ratio for a positive combined November-December return. And the sort of point estimate is actually a return of 5% combined over those 2 months. So that is, of course, very strong. And the negative outcomes are really, really quite small and very few. Now, to believe in the seasons, I think you have to ask the question why they happen, and that gives you more confidence in them. And I think there are 3 reasons. One is that investors suffer from recency bias. If recently things were going well, they expect the next year to go well, and they want to pre-position for 26. And certainly I think people are bullish for 26, where they expect probably still some Fed cuts, a bit of a fiscal boost, tariffs sort of fading away, and some deregulations. Overall, I think people want to be long going into 2026. The second reason is that the investors who missed the trade have still time to catch up and to beat their benchmarks. And we see some of that behavior late in the year as well. And then the last one is that you get reduced tax loss selling, right? Because there are fewer losses around if the tape was strong. And so there are less tax loss selling, and that also is helpful for the market. So all that suggests to us that into year end, yes, the market is obviously not cheap, but you still want to be long. So summing up the discussion, our best guess is that the weak labor market is so far mostly about high rates and maybe a little bit about lagged tariffs. Eventually, AI will kick in, but so far the evidence is still really quite weak. But when that happens, the equity market could really benefit from both the productivity, of course, but also from renewed Fed dovishness. And that keeps us bullish equity camp. Thank you for joining us today. This episode was recorded on November 3rd, 2025, and I'm your host, Dirk Willer. For more details, Citi clients can check out our report on the Citi Velocity portal. If you enjoyed the podcast, please leave us a review on your favorite podcast platform. Next week's Research at Citi Markets Edition will be hosted by Adam Pickett, Citi's head of global equity strategy. And be sure to watch our Research at Citi podcasts, which you can view on the same channel. The macro strategy team will be back in 2 weeks. Stay sharp.
This podcast contains thematic content and is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information, and although obtained from sources believed by Citi to be reliable, its accuracy and completeness are not guaranteed. Past performance is not a guarantee or indication of future results. This podcast may not be copied or distributed, in whole or in part, without the express written consent of Citi. Copyrights 2025 Citigroup Global Markets, Inc. Member SIPC. All rights reserved. Citi and Arc Design are trademarks and service marks of Citigroup Inc. or its affiliates and are used and registered throughout the world.